In this video, we'll discuss Chapter 7, Risk Analysis of Business Finance Essentials. We'll talk about risk, probability, and the magnitude of outcomes impacting risk, sources of risk, and differentiating between economic risk factors and firm-specific factors, probability distributions, expected returns, standard deviations for single securities, interpreting expected return and standard deviation, correlation. We'll also look at portfolios, two-stock portfolios, look at diversification, different types of risk, how to measure risk, beta, the capital asset pricing model or CAPM, and the SML or the security market line. Risk refers to the possibility of an unfavorable event occurring. The higher the risk, the greater the probability of an unfavorable event, or the more unfavorable the event could be. The interaction of the probability of the unfavorable event and the degree of negativity associated with the event is critical to determining risk. For instance, imagine that you're going to participate in a coin flip. It will cost you $1 to participate. If you flip a head, you get $1.01. If you flip a tails, you get 99 cents. Even though there's a fairly high probability of the unfavorable event, 50% of tails, the outcome is so minor you lose a penny that this would be a low-risk event. Now consider a slightly different coin flip. This time, instead of flipping the coin once, you'll flip it 3 times. 3 heads, you receive 10,000. 3 tails, you owe 10,000. Anything else, you get your dollar back. Even though the probability of the bad outcome is much smaller, a 12.5% chance of flipping 3 straight tails, this is a much riskier event due to the bad outcome being substantially worse. However, most people do not consider flying a commercial airliner to be a high-risk event, even though the worst-case scenario is obviously quite severe, because of the extremely low probability of a fatal crash, less than 1 in 10 million. It's not just the probability or just the degree of unfavorable outcome, but the combination of the two that matter for rational risk analysis. In finance terms, our unfavorable event refers to earning less than expected. Anytime we have a chance to earn less than expected on an investment opportunity, we are exposed to risk. Note that this is a more strict definition than defining risk as the possibility of losing money. We want to be careful to think of risk as the possibility of earning less than expected instead of being the possibility of losing money. Note that the above list is a sample of broad factors and not a specific list. For example, consider what happens when we have a large increase in oil and gasoline prices. One immediate impact is inflation. The higher energy prices are, by definition, inflation in energy, but it goes beyond that. Now it costs more for firms to distribute their products to suppliers, which is likely to cause the inflation to spill over to other areas. As we search for alternative energy sources like ethanol, we may see corn prices rising. Since corn is used to feed cattle, this could lead to an increase in beef costs as well. Also, if consumers are now spending more to fill up their gas tanks and more to buy a variety of food products, there would be less money available to spend on entertainment and other goods or services. This could lead to a recessionary environment, could, not will, because there are always so many influences on the economy that this is just one of many factors impacting economic growth. The point here is not the specific impacts of higher oil gasoline prices, but that many economic risk factors may have more complex interactions than are apparent at the surface. One other thought on risk to keep in mind as we move through this is that we'll be treating risk and potential returns as largely objective and measurable. In practice, one of the biggest challenges of risk management is trying to figure out what bad outcomes are and how likely they are. John Kenneth Galbraith, one of the greatest economists of the 20th century, once wrote, "There are 2 kinds of forecasters, those who don't know and those who don't know they don't know." In practice, the results of our models are only as good as the inputs we put into them. Diversification refers to the concept that by holding a number of different securities, ideally not just stocks, from a spectrum of industries, we can negate the impact of company-specific factors on our returns. We'll come back to this later, one of the most important concepts in finance. The expected return of a security is based on the probability distribution of returns. Before we get into the details of expected return, let's briefly introduce the concept of probability distribution, which is a representation of possible outcomes or states of nature that may occur and the likelihood or probability of each outcome. If you think of a coin flip, the probability distribution has 2 possible outcomes, heads or tails, and each outcome has a 50% chance of occurring. Technically, this is not true, as even in the fair coin flip, the side that starts up has about a 51% chance of occurring. When dealing with financial securities, the number of possible outcomes is nearly infinite, and it's not possible to know the exact outcomes or probability of these outcomes. Therefore, we are really only approximating the true probability distribution. Specifically, the expected return is the probability of a specific state of nature occurring times the return under that state of nature summed across all possible states of nature. In formula terms, it is demonstrated below. K bar represents the expected return of the stock. P sub I represents probability of the possible outcome or state of nature. K sub I represents return under the outcome or state of nature. P sub n represents the probability of the nth possible outcome or state of nature. And K sub n represents the return under the nth outcome or state of nature. Don't worry if the formula and definition seem intimidating. The process is relatively simple. Consider the following. After researching stock A, we have determined that there are three possible outcomes for the next year, or three states of nature. First possibility is the economy enters a recession, causing the stock to have a return of negative 15%. The probability of this occurring is 20%. Second possibility is that the economy goes smoothly but does not experience rapid growth, causing the stock to rise and offer a 10% return. The probability of this occurring is 50%. The third possibility is that the economy booms, causing the stock to provide a 35% rate of return. The probability of the economy booming is 30%. Note that the probabilities must sum into 1 and states of nature should be mutually exclusive. Here we see the table and then the results. So K bar is 0.2 times negative 15% or negative 3%, plus a half of 10% is 5%, plus 0.3 times 35% is 10.5%. Summing that up is 12.5%. That's the expected return K bar. Standard deviation measures the variability of possible returns and is represented by the formula you see below. So sigma is what it's represented by. The smaller the standard deviation, the more likely we're going to earn something close to our expected return. The greater the standard deviation, the greater the chance that we may earn something far more good or far less bad than our expected return. The formula for this, noting that K bar is our symbol for expected return, is demonstrated below. It's easy to get confused with decimals and percents. The best way to do these calculations is to always leave the weights as decimals and the returns as a regular number. For instance, if you have a probability of 0.1 and return of 15%, you would put the probability into your calculator as 0.1 and then the return is 15. Be careful with your order of operations. Do K1, so each outcome minus, or the first outcome minus K bar first, then square that, then multiply by P sub 1. Repeat this process for all n states of nature so you'll loop until you're done. Then add them up, and then finally take the square root. The answer to the previous problem is given below. The expected return gives us an idea of how much we will make on the investment. Remember, this is not how much we'll make, but how much we would make on an average if we could repeat the holding period an infinite number of times. Think of a situation where you're asked to pick a number between 1 and 10. If you select the correct number, you get $100, and if you do not, you get nothing. Any one time that you try this, you'll either receive $100 or zero. However, you could repeat the exercise 100,000 times, and you would find that you would make almost exactly $10 per time. It's critical to know expected values when selecting investments. For instance, if someone offered you the opportunity to do this exercise for $9 per pick and you could pick as often as you wanted, it would be an excellent opportunity. Alternatively, if you offered the same thing for $11, you would hopefully walk away. However, it is just as important to understand that the expected return is only an average return and not the return you will receive in any particular instance. This example also illustrates why it's so important to focus on the process and not the result. If you had the opportunity to play this game once for a cost of $2 and you lost, it still was a smart decision to play, and you should do it again if you got the chance. If you had the opportunity to play this game once for a cost of $20 and you won, it was still a bad decision to play, and you should pass if offered the opportunity to try again. Consider a similar exercise. Pick a number between 1 and 5. If you select the correct number, you get $50, and if you not, you get nothing. Expected value for this exercise is the same as the previous exercise, $10. So imagine that you're offered the opportunity to participate in either one, pick from 10 numbers or pick from 5 numbers for $8. You can only play once. Most people will now choose to pick from 5 numbers. Why? Because it has less risk, a lower standard deviation, and offers the same expected return. This is the concept of risk aversion. As a side note, if you still pick the 10 number game, it's likely because the stakes are small. The entertainment value of the gamble outweighs the financial aspect. As the stakes increase, the vast majority of people will choose the 5 number game. Moving away from our example, let's put this in finance terms. Consider 2 stocks. Stock A has an expected return of 10% and a standard deviation of 25%. Stock B has an expected return of 10% and standard deviation 30%. Which should you choose and why? Now consider 2 other stocks. Stock C has an expected return of 7% and standard deviation 20%. Stock D has an expected return of 9% and standard deviation 28%. Which should you choose and why? In the first example, you should choose Stock A, and so should everyone else. Stock B offers us no additional compensation or expected return to entice us to take the higher risk or standard deviation. Therefore, it's irrational and a risk-averse framework to invest in Stock B. In the second example, you could choose Stock C or Stock D, and someone else may make the same choice or the opposite choice. Here, the choice is based on your individual level of risk aversion. Stock D is riskier, but it also compensates us for that risk with a higher expected return. Is the compensation enough? That depends on the individual. For those that are less risk averse, they require less additional compensation to take on the extra risk, so they will likely take Stock D. For those that are more risk averse, they will take Stock C, because the extra compensation is not enough for them to take the extra risk. Take a few moments and try to think of what factors impact your level of risk aversion. Typically, we find that age, personality, number of dependents, wealth, income, variability of income, past life experiences, and other factors all combine to influence one's level of risk aversion. Note that taking Stock D does not mean you'll earn a higher return, just that you will earn a higher return on average. If you always earned a higher return from Stock D, then it would not be riskier. Visually, you can think of it along the lines of the diagram below. At low levels of risk, the range of returns will be close to the expected return. At high levels of risk, the range of returns will be higher. The expected return increases with risk, but so too does the range of potential returns. The expected return for a portfolio is simply the weighted average of each stock held in the portfolio. Note that the weights have to sum to 1. In this example, suppose 60% in Stock A and 40% in Stock B. Stock A has an expected return of 10% and for B it's 20%. So 0.6 times 10% is 6%, plus 40% of 20% is 8%, which yields a portfolio expected return of 14%. The standard deviation portfolio becomes more complicated. It depends not only on the standard deviation and weightings of each stock, but also on the correlation between pairs of stocks. The correlation between a pair of stocks measures how closely the returns for each stock are related. A negative correlation means that the price of one stock tends to fall while the others rise. Prices to returns are inversely correlated. A positive correlation means that the price of one stock tends to rise while the other rises. Prices returns are positively related. Correlations can range from -1 to 1. Correlations for real-world variables are almost never at the extremes: perfect positive, no correlation, or perfect negative. The last 2 rows or columns are for an aggregate U.S. bond fund and the S&P 500 ETF. The purpose of these is to provide a proxy for the U.S. bond market and the U.S. stock market. The vast majority, 57 of the 66 correlations between pairs of stocks, are positive. This is because all stocks are impacted by general economic factors. The average correlation across pairs is a low positive value, while general economic factors cause a tendency for stocks to move together. Firm-specific factors push correlations toward 0. Stocks in similar industries tend to have higher correlations than the average stock. Each stock has a positive correlation with the overall stock market. The stock and bond market have a negative, although essentially 0, correlation during this time period. The bond market has a much lower standard deviation, than the stock market, but also generated much lower returns during this time period. Each individual stock has a standard deviation that is higher than the overall stock market. This is because the stock market represents a diversified portfolio which has eliminated most of the firm's specific risk. The historical annualized returns are not the same as the expected returns. It's unrealistic to expect 20% or more annual returns for Amazon or Alphabet going forward, which is not the same as saying that these stocks cannot generate those returns. Also, it is unreasonable to expect people to buy stock in Exxon with the anticipation of less than a 3% annual return. While standard deviations will vary depending on overall market conditions, large cap stocks over this 5-year window have standard deviations of approximately 12 to 27%. Note that the standard deviations will be bigger or smaller depending on both the stock and the time period used. To calculate the standard deviation of a two-stock portfolio, we use the formula here. The standard deviation portfolio is equal to the weight of the first stock squared times its variance, plus the weight of the second stock squared times its variance, plus 2 times each of the weights times their standard deviations times the correlation between the two. We then take the square root of all of that to get the standard deviation of the portfolio. Note in this example, the standard deviation of the portfolio is less than the standard deviation of either stock separately. This illustrates diversification. As long as the correlation is less than 1, which it will be for any two stocks, the risk of the portfolio is less than the weighted average risk of the two securities which make up the portfolio. And sometimes, like here, even less than the lowest risk stock in the portfolio. While we'll not cover the process of calculating the expected return standard deviation for larger portfolios here, in practice, most portfolios hold far more securities. Remember earlier we discussed the possibility of lowering a firm's specific risk by holding a number of stocks from a wide range of industries. This concept of diversification allows us to greatly reduce our risk by holding a portfolio. Diversifiable risk refers to risk factors that are isolated towards one particular firm or industry. For example, if a drug manufacturer gets hit with lawsuits related to one of the drugs it produces, that is likely to have an isolated impact. It will not have any effect on the stock prices of auto manufacturers, grocery retailers, banks, etc. Once we have enough stocks in our portfolio, bad news for any one of them will have a small impact on our overall portfolio as long as that bad news is contained to that one firm. In other words, as long as it comes from a diversifiable risk factor. By holding approximately 25 to 50 stocks, we can eliminate a large portion of our diversifiable risk, according to Statman 1987. While a portfolio of 10 stocks is much less risk than a portfolio of 5 stocks, a portfolio of 100 stocks offers very little risk reduction compared to a much smaller 50-stock portfolio, assuming our stocks are from a variety of different industries and have other differing characteristics. Does this mean that we have eliminated all of our risk when we hold a 50-stock or even 500-stock portfolio? No, we are still subject to general economic risk that affects all securities. This leftover risk is referred to as non-diversifiable risk or market risk or systematic risk. Examples of non-diversifiable risk include political events like wars, energy price shocks, changes in interest rates, recessions, etc. Any risk factor that impacts virtually all stocks is referred to as a non-diversifiable risk factor because it will impact the portfolio regardless of how well we have diversified our investments. Another name for non-diversifiable risk is market risk because these sources of risk tend to affect the entire market as opposed to an individual security or industry. Note that market risk does not refer to risk impacting a specific industry. Instead, it refers to risk impacting the broad economy, most stocks. If a risk factor only impacts one or two industries without carrying over to the broader market, it is classified as firm-specific. The following graph does a good job of illustrating the concept of diversification and firm-specific versus market risk. Given the relative ease with which investors can virtually eliminate their firm-specific or diversifiable risk, for most investors, the level of non-diversifiable or market risk associated with an investment becomes more important. It is important to note that while market risk impacts all stocks, it does not impact all stocks equally. Therefore, we need a tool to measure how sensitive a stock is to the overall market. This tool is known as beta. It's the standard deviation that measures the total risk or diversifiable risk plus market risk for a security, while beta measures the degree of market or non-diversifiable risk. We will not introduce a risk measurement for diversifiable risk. So beta is equal to the standard deviation of the asset times the correlation of the asset and the market divided by the standard deviation of the market. The market refers to a portfolio of all investment assets like stocks, bonds, gold, art, etc. In more practical terms, the market usually refers to the stock market and can be measured by a market index like the S&P 500 or DJIA or the Dow Jones Industrial Average. In this example, stock A had a standard deviation of 60%, overall stock market standard deviation 25%, and the correlation was 0.3. So the beta was 60 times 0.3 over 25, which is 18 over 25 or 0.72. Most betas range between 0.35 and 1.8. There are many outside the range, but the majority of stocks fall in this range. Going back to our example, we calculate the beta for stock A. By itself, stock A is much riskier than the overall market as determined by its standard deviation. However, when we consider it as part of an overall portfolio due to its risk, it's much lower, less than average, due to the fact that it has a relatively low correlation to the overall market. The riskiness of stock A depends on whether we plan to use it as a standalone investment or as part of a portfolio. So far, we've introduced two risk measurements. The first is standard deviation and the second is beta. In some cases, these two risk measurements will tell a different story. For example, stock A may have had a standard deviation of 30% and a beta of 0.8, while stock B may have had a standard deviation of 25% and a beta of 1.3. Which stock is riskier? The answer depends on the specific situation. Because each risk measurement is measuring a different type of risk, or standard deviation measuring the total risk, while beta measures market risk, we need to think of situations where each is appropriate. A single security and/or a poorly diversified portfolio. If you're going to place your entire investment into a single security or a poorly diversified portfolio, the standard deviation is the appropriate risk measurement. In this situation, you have not diversified away the majority of the firm's specific risk, so you'll need to include it in your analysis. Standard deviation does this because it includes both sources, the market and firm-specific risk. If you own a well-diversified portfolio and you're planning to add a single security to that portfolio, then the firm-specific risk of the security you're adding is not relevant. The reason it's not relevant is because it will be one of many stocks in the large portfolio, and the firm-specific risk will be diversified away. What matters is how that stock moves to the overall market. Since we measure this market risk with beta, our appropriate risk measurement here is beta. Choosing between two or more well-diversified portfolios. So if you're choosing between these two in that case, that are each well-diversified, then you can use either standard deviation or beta as your risk measurement. The reason for this is that at this point, the firm-specific risk is already diversified away, so your total risk and market risk should be about the same. Thus, whichever portfolio has the higher standard deviation should also have the higher beta. If not, the portfolios are not well diversified. During the mid-60s and early 70s, some finance professors developed the capital asset pricing model, the CAPM, Sharp, Littner, and Black. One of the key components of this model is the security market line, or SML, which states that the required rate of return for a stock is dependent on the beta of that stock. While technically the SML is a subset of the larger CAPM, in practice the two terms are typically used interchangeably. Think of them as the same basic model. So the SML states that the required return for a stock is equal to the risk-free rate plus beta times the difference between the market average return and the risk-free rate. The risk-free rate is often approximated by the yield on a 10-year U.S. Treasury, and the KM, the expected market return, is often approximated by the S&P 500 index. The required return for this stock B, beta 1.4, expected return of 11%, Treasury bond rate of 5%, is 5% plus 1.4 times the difference between 11 and 5%, or 6%. So 5% plus 8.4% is 13.4%. According to SML, high beta stocks should on average earn higher returns than low beta stocks. According to SML, the only factor that should cause consistent differences in returns across stocks is beta. When interest rates rise, required returns should increase, and all else equal, stock prices should fall. When investors become more risk averse, the risk premium, or the difference between the market return and risk-free rate, should increase, which will increase required returns, and all else equal, cause stock prices to decline. Under equilibrium conditions, the required return should equal the expected return. Previously, we estimated the required return for stock base should be 13.4%. What would happen if the expected return for this stock was 16%? Think through what would happen if the required return was 13.4% and the expected return was 9%. Think about what types of things may push us out of equilibrium and why this is relevant for explaining stock price movements. The below diagram illustrates the logic in terms of us getting from start to finish, not being in equilibrium into equilibrium. The reverse would also be true. While the CAPM or SML met with a lot of early success and became the standard for estimating required returns in the field of finance very quickly, it started running into problems in the 90s. Fama French 1992. There have been some alternative models like the Fama French 3-factor model, 5-factor model, Q-factor model, and Carhart 4-factor model that's been introduced since then. But there hasn't been a new standard bearer to take its place. Right now, the SML is still commonly used in practice, however, there's growing focus on alternatives. It's critical for you to know and understand the basic premise of the CAPM and SML, the role of market risk in explaining returns, but also to be aware of some of the problems that are listed below. These flaws do not mean that the CAPM or SML are useless. They provide a simplified framework for understanding how market risk relates to returns. Recognize that they are not perfect models, and the process of understanding stock returns is more complex than the SML indicates. As our knowledge increases, better models will likely evolve. The relationship between risk and return is an essential element of financial analysis. Investors tend to behave in a risk-averse manner, so we're going to anticipate that higher risk investments should have higher expected returns. We formalize this analysis by introducing measures of risk, the standard deviation and beta, as well as expected return. Standard deviation captures the dispersion of possible returns or total risk and is best used when evaluating individual investments in isolation or poorly diversified portfolios. Beta captures the risk of securities relative to the overall market or market risk and is best used when evaluating individual investments within the portfolio. The portfolio represents a collection of securities held together and is an essential tool for diversifying away from specific risk. The lower the correlation between a pair of securities, the more potential diversification benefits there are. This is reminiscent of the do not put all your eggs in one basket cliche. While diversification can virtually eliminate the impact of firm-specific risk, it cannot eliminate market risk. Investors should be compensated for the degree of market risk that they're exposed to in their investments. The SML formalizes the risk-return trade-off with respect to beta, the risk-free rate, and the market risk premium. It hypothesizes that higher beta stocks should generate higher returns and beta should be the only factor that systematically differentiates returns. The SML has not held up well to empirical testing, which has led to the introduction of newer attempts to formalize the relationship between risk and return. While the specific nature of risk and return is not finalized, it's safe to say that in general, higher risk should be rewarded with higher expected returns. However, it's important to remember that expected returns are not the same as realized returns due to the nature of the risk. Now turning to questions. In finance terms, risk refers to the possibility of earning less than expected on a particular investment over a given time period. For instance, if I make an investment and anticipate earning a 5% rate of return over the next year, I'm exposed to risk if there is any chance that I earn less than that 5%. The two factors that determine the degree of risk are the extent to which I can earn less than expected and the likelihood that I will earn less than expected. If my expected return is 5% and the worst possible outcome is that you earn 4%, there's not a lot of risk. However, if there's a chance you'll lose 60%, your risk is much higher. If I will make 5% 99.5% of the time and lose 50% only 0.5% of the time, my risk is also not very great because the chance of a bad outcome is very small. High risk investment means there's both a significant chance of earning less than expected and the amount less that I can earn is relatively large. As long as we cannot lose any money, we have a risk-free investment. This is false. You can avoid losing money and still earn less than expected. Very small rates of return over long periods of time are bad outcomes, and the chance of that happening means you're exposed to risk even if you cannot lose money. While both activities use risk in an attempt to earn a profit, there are several important differences. The risk-return profile is different. Most forms of gambling have a negative expected return because of the house edge. Even games where you might argue that some people have a positive expected return, like sports betting or poker, The average individual will lose money due to the fixed cost of paying the gambling institution offering the wager. On the other hand, investing typically offers a positive rate of return. While stocks and bonds have both had periods of negative returns, the long-run rate of return on both is significantly positive. Another difference is that investing provides capital to a variety of businesses. Without stock and bond markets, there would be far fewer jobs and product innovation, as the stock and bond markets provide the capital for businesses to operate. Gambling, on the other hand, tends to transfer wealth instead of create it. Note that this discussion does not imply that gambling is wrong and investing is right. Instead, the point is to illustrate that the combination of positive expected returns to investors and providing capital to businesses makes investing a net positive to society, while gambling tends to transfer wealth from gamblers to gambling institutions and is thus neutral in creating wealth. Correlation measures the extent to which two variables or returns move together. If two securities have a high positive correlation between 0.5 and 0.99, this means they have a strong tendency to move in the same direction. When one security increases in value, it's likely the other will as well. When one decreases in value, it's likely the other will as well. Since the correlation is less than 1, it will not always move in the same direction. Two securities have high positive correlations, could be any two securities in the same industry. Industry pressures will lead the securities to move in a similar direction most of the time. However, firm-specific factors will keep the correlation less than 1. If two securities have a low positive correlation between 0.01 to 0.49, this means they have a weak tendency to move in the same direction. While they move in the same direction up or down more frequently than not, it is not uncommon for one to be up while the other is down. Two securities with low positive correlations could be any two companies without a specific connection. For instance, Amazon and Exxon. Both will be exposed to the same general economic factors leading to a positive correlation, but the different industry and firm-specific issues will keep the correlations low. In general, most stocks should have low positive correlations. If two securities have a negative correlation, that means that they tend to move in opposite directions. The closer to -1, the stronger the inverse relationship. Due to general economic factors, few stocks will have negative correlations, at least as an expectation. One possible example might be oil producers and trucking firms. Since an increase in oil prices will improve the value of assets and profits for the oil firms and lower profits for trucking firms, we might see negative correlations. However, the ability of trucking firms to pass along higher prices in periods with low oil price volatility will mean that even here we may not see that significant of an inverse relationship. What is diversifiable risk? What is market or non-diversifiable risk? And give an example of each. Diversifiable or firm-specific risk is risk that can be virtually eliminated by holding a large portfolio of securities from a variety of industries. An example of a diversifiable risk would be the success or failure of a new product introduction by a firm. If Ford's new auto line is poorly received and results in a bad year or two for the automaker, will not impact the other stocks in the portfolio. As long as you own several other stocks in a variety of industries, your overall portfolio will not be hurt much by Ford's problems. Non-diversifiable market or general economic risk is risk that cannot be eliminated by holding a large portfolio of securities from a variety of industries. An example of a non-diversifiable risk would be a sudden surge in inflation. This would result in most stocks declining and couldn't eliminate this risk regardless of how many stocks were in your portfolio. The diagram below indicates how we diversify away most of our firm-specific risk in a large portfolio of 25 to 50 stocks, but market risk remains. Standard deviation measures total risk. Total risk is both firm-specific and market risk combined. Standard deviation is important when you consider putting all your money into a single security or a non-diversified portfolio. Total risk needs to be considered in these situations is because we haven't diversified away our firm-specific risk, so it's still relevant. On the other hand, if we're adding a security to a well-diversified portfolio, the standard deviation of that stock is not important. Because we own a well-diversified portfolio, the firm-specific risk of the stock will be unimportant. We only need to focus on the market risk. Beta is a measure of market risk. While every firm is market risk and it cannot be eliminated in a portfolio, some firms are more sensitive to market or general economic factors than others. Therefore, the market risk of some stocks will be higher than the market risk of others. A portfolio of stocks with high market risk can still be diversified so that firm-specific issues are not relevant, and yet increase at a rate faster than the market or decrease at a rate faster than the market. When we're adding security to a well-diversified portfolio, we no longer need to be concerned about firm-specific risk, but only about market risk and how it will affect our portfolio's sensitivity to general economic or market forces. When we're considering investing all of our money into a single stock, beta is not relevant because we need to focus on the total risk instead of just the market risk factors. Explain why we can use either beta or standard deviation when comparing two well-diversified portfolios. Is this true for any two portfolios? When we compare two well-diversified portfolios, either beta or standard deviation will work. This is because since both portfolios have essentially zero firm-specific risk, the total risk of the portfolio will effectively equal the market risk of the portfolio. Whichever portfolio has more market risk or higher beta will also have more total risk or higher standard deviation. So if you're evaluating the risk of a single security in isolation or comparing two poorly diversified portfolios, use standard deviation. If you're evaluating the risk of a security to add to a well-diversified portfolio, use beta. Comparing the risk level of two well-diversified portfolios, you can use either one. The stock should increase by 12.5%. While in reality it will likely increase by either more or less than 12.5%, your best guess today would be for an increase of 12.5%. If it increased by more than 12.5%, it would be because firm-specific factors turned out positive, and it increased by less than 12.5% or dropped, it would be because firm-specific factors turned out to be negative. The 12.5% is based on the firm's sensitivity to market factors. If you thought the stock market was going to decline by 5%, you would expect your stock to decrease in value by 6.25% because 1.25 times negative 5. For a stock with a beta of 0.6, it should increase by 6% if the market climbs by 10% and fall by 3% if the market declines by 5%. The statement is true. High beta stocks imply higher than average risk. Higher than average risk implies higher than average expected returns. We can also see this by looking at the security market line. If we have a beta of more than 1, the required return will be greater than the expected return on the market. This relationship is based on expected returns, not actual returns. The nature of risk is that sometimes we will lose money, and with high risk we may lose a lot. While our expected returns are greater than the average return on the market, our realized returns may be higher or lower. Over long periods of time with well-diversified portfolios, we should earn higher than average returns if beta is a good measurement of risk. The statement is false. Expected return does not mean realized return. On average, we would make more money from stock B over the course of the next year. We do not get to repeat next year 10,000 times the retro average. Instead, we get one shot. It's possible stock B will earn quite a bit less than expected return, and stock A will earn quite a bit more. In equilibrium, expected return should equal required return. If this is not true, the price will adjust until we move back into equilibrium. In this example, the expected return moves to 18% while the required return stays at 13%. This means investors anticipate earning an 18% return on average, while a 13% return is enough to compensate them for the risk they are taking. Since they can earn 5% more than they need to compensate them for the risk, they will buy the stock. As a large number of investors start buying the stock, the price will increase. Since the expected cash flows associated with the stock are not changing, the higher price means that there will be a lower expected return. The price will continue to go up until the expected return falls to 13%. At that point, there is no reason for people to keep buying the stock and pushing up the price because they are only earning the required return. At this new price, the stock is worth buying, but at any higher price, it would not be. Thus, we're back in equilibrium. This process should happen instantaneously if markets are efficient. People will see the discrepancy between expected and required returns and start buying immediately. With everyone wanting to buy at the same time, the price will respond immediately. A lot of people struggle with this idea that an increasing price leads to a lower expected return. At first glance, it seems counterintuitive as we see the stock price going up. We may think that it's a good stock and expect it to continue to go up more than the future. However, if you think of a stock as the present value of all expected cash flows and we increase the price while holding cash flows constant, you can see that you're paying more for the same set of cash flows. Since you are paying more for the same set of cash flows, you should expect to get a lower rate of return on your investment. Now turning to some problems. Find the expected return and standard deviation of stock A with a 20% probability of negative 30%, 40% probability of 15% return, and 40% of 30%. Stock B has a probability of 30% of negative 5%, 40% of 10%, 30% of 20%. If you're going to put all your money into one stock, which should you pick? Expected return of A is 12%, expected return of B is 8.5%, standard deviation A is 22.05%, and standard deviation of B is 9.76%. You could pick either one. People that are more risk averse will choose B. Both choices are consistent with risk aversion because the stock with higher risk, stock A, also has a higher stock return. Find the expected return and standard deviation of each stock. 30%, 50%, 20% probabilities for C returns are negative 10, 15, and 40% respectively. For D, they're 25, 10%, and 0% respectively. Then calculate the expected return and standard deviation in portfolio that are half and half of each stock with a correlation of negative 0.75. Would you prefer to put your money in stock C, D, or the portfolio? We should choose the portfolio because all three choices have the same expected return, but the portfolio has the lowest risk. All risk-averse investors will choose the portfolio over either stock individually here. Assume two stocks. Stock A had an expected return of 20%, standard deviation 25%. Stock B had an expected return of 15%, standard deviation 20%. You want to create a portfolio made up of 65% of stock A and 35% stock B. Find the expected return standard deviation of this portfolio when correlations are 1, 0.50, negative 0.5, and negative 1. For the first one, the expected return is 18.25% with a standard deviation of 23.25%. And note in this case, that's just the average standard deviation between the two. For 3B, you get 18.25% and 20.66% for the expected return and standard deviation, respectively. Note that the expected return is not a function of the correlation, while the standard deviation declines as the correlation drops. This is the free lunch of diversification. As long as we invest in securities with a correlation of less than 1, we will lower our risk because the standard deviation is less than the weighted average of each stock's standard deviation without lowering the expected return. The expected return will be the weighted average of each stock's expected return. The stock of Ralph's Restaurants has a standard deviation of 70% and the correlation with the market of 0.4. The expected return for the market is 13% and standard deviation 20%. The risk-free rate is 5%. Find beta, the required return, and expected return. In equilibrium, expected return equals required return. Since the required return is 16.2%, the expected return should be 16.2% as well. We're purchasing a stock that just paid a dividend of $1.50. The growth rate in dividends for the stock is 4% and has a beta of 1.3. The expected return on the market is 12% and the current treasury rate is 7%. How much should we pay? So we know stock price should be found using P0 equals D1 over K minus G. G is 4%, so D sub 1 will be the first dividend times 1 plus the growth rate, so 1.5 times 1.04 is 1.56. K is equal to 7% plus 1.3% times the difference between 12 and 7%. So using the CAPM, we get 13.5%. So 1.56 over 0.135 minus 0.04 is 1642. That's what you should pay. Be sure to like and subscribe as well as comment for more content like this. Now turning to a tutorial. Its purpose is to walk through the process of calculating and interpreting several concepts. Note that this is not a substitute for what was previously covered, but a complement. We're going to start by estimating expected return and standard deviation of a single security. This is used when evaluating investments in isolation or standalone situations. To do these calculations, we're going to start with a probability distribution of possible outcomes. Probability distributions will be discrete because there are a limited number of outcomes. They are not designed to capture every possible event that could happen in the real world, as there are potentially infinite outcomes, but instead just to provide a quick overview of some possible scenarios. Once we calculate expected return and standard deviation, we can evaluate which investment is better by itself. The next step is to look at the portfolio impacts. In practice, many people hold portfolios of tens or hundreds of different investments. We're going to limit our calculations to a two-stock portfolio to keep things simple. The standard deviation formula really gets bigger as we add more and more securities to the portfolio to the point where it can be very time-consuming to do by hand once we get more than a handful of securities. Here we'll introduce correlation, how the returns form a pair of securities that move together, and consider how it impacts the risk of our portfolio. Portfolios and the concept of diversification are a critical element to investing in your personal financial decisions as you manage your real-world finances throughout your life. After we've gone through the portfolio, we'll introduce beta that becomes critical once we move to larger, well-diversified portfolios. Beta gives us a measure of market risk, which was introduced previously. When we evaluate securities in isolation, we want to use standard deviation because total risk is firm-specific risk plus market risk. However, when we add stocks to a well-diversified portfolio, we no longer worry about the firm-specific risk as it has been diversified away, and now we focus on the market risk, or beta. From there, we'll discuss the security market line, which attempts to integrate the concept of market risk, or beta, and required return for a security. In other words, what rate of return do we need in order to compensate us for the risk of investing in the stock? We can then tie that back into expected returns and stock valuation issues. You should work through this as discussed and think about this instead of just reading and listening. You will get more if you do that. Calculate the expected return in standard deviation for Big Oil Inc. given this probability distribution. As Big Oil Inc. is an oil producer or refiner, it stands to reason that their stock price will be partially dependent on the price of oil. As oil increases in value, the stock price should go up as the value of Big Oil's oil assets increases and vice versa. Note that Big Oil is impacted by a lot more than the price of oil, like labor costs, regulations, economic growth, etc. A real-world analysis will be more complex and have several more scenarios. For this, we want to keep it relatively straightforward. This probability distribution is telling us that there's a 5% chance we'll lose 40% of our investment over the next year, a 20% chance we'll lose 20% of our investment over the next year, and so on. Note that for any probability distribution you use to get expected return standard deviation, your probabilities have to sum to 1. The expected return is 9%. This does not mean we'll get 9% as our rate of return. It also does not mean that 9% is our most likely return. As a matter of fact, based on our probability distribution, 9% isn't even a possible outcome, and 12% is our most likely return. Instead, what this means is that if you could repeat next year an infinite number of times, sometimes you do better than 9%, sometimes you do worse, but on average you would have a 9% rate of return. Knowing that 9% is your expected return is only part of the story. An analogy that works here is to imagine that you do not know how to swim, but must walk across a lake that's on average 3 feet deep. While you may be perfectly fine standing in 3 feet of water, it is pretty easy to see the problem. The average depth doesn't help you when you get to the spot where the water is 15 feet deep. It is not enough to know the average depth, you need to know the variation in depth. We can get a feel for this through the standard deviation. While it is not a statistically precise definition, think of standard deviation as a measure of how reliable the expected return is. When you have a low standard deviation, that means that most of the time your actual return will end up close to your expected return. When you have a high standard deviation, that means that you are likely to have an actual return that is significantly higher or lower than your actual return. Note that stock returns are not normally distributed, so do not think of standard deviation as a precise confidence interval. A standard deviation is a measure of how reliable our expected return is. We can think of it as a measure of risk. So calculating this, we get 21.79%. The higher the number, the more likely our actual return is to be significantly higher or lower than our expected return. To see some actual standard deviations for real companies, look back at the previous slide with that information. Pepsi has a standard deviation of just under 12% from January 2013 through December 2017, while Boston Beers, the maker of Samuel Adams, is about 30% over that same time frame. Note that standard deviation and risk is a function of the interaction between the likelihood of an unfavorable event and the degree of the unfavorable event. We can see that in standard deviation formula. The K segment of the formula captures the degree of the unfavorable event. The further from our expected return, the greater this value will be. The probability captures the likelihood of the unfavorable event. If one or both of these values is small, it will have little impact on the standard deviation. On the other hand, if they are both larger, it will lead to a larger standard deviation with more risk. In order to evaluate where Big Oil ranks in terms of risk and return, we need to compare it to an alternative. Stacked tractors has a 15% chance of negative 60% return in a recession. Slow economic growth of 50% leads to 9% return. And strong economic growth has a 35% chance with 50% return. Comparing these two stocks, if you're a risk-averse investor, which should you choose? The answer is either one, depending on your degree of risk aversion. Big oil is less risky, lower standard deviation, but it also has a lower expected return. Stacked tractors is riskier, but you're compensated for that additional risk with an extra 4% expected return. Is that additional 4% expected return enough extra compensation for the extra risk? The answer depends on the person. People that are more risk averse, more sensitive to risk, will likely prefer big oil. People that are less risk averse will likely prefer stacked tractors. If the expected return for stacked tractors was only 10%, would some risk averse investors still choose it? The answer is yes, although the number choosing stacked tractors would be fewer in this case, as fewer people would find the extra compensation of only 1% adequate to compensate for the extra risk. As long as the higher risk alternative pays a higher expected return, there should be some people that will choose to do it. However, the number that choose the higher risk stock will increase as the extra compensation or difference in expected returns increases. If the expected return for stacked tractors was only 9%, same as big oil, or lower, now all risk-averse investors would choose big oil as there is no additional compensation for taking on the higher level of risk. Note that one factor that might influence your decision is your time horizon. If you have a $10,000 to invest, if you earn 9%, you'll earn $900 compared to $1,300 if at a 13% return. The difference of $400. Keep in mind that is based on expected returns on average, not actual returns. That $400 difference is probably not very significant when you consider the possible upsides or downsides. However, if your time horizon was 35 years and you start with 10,000, earn 9% for 35 years, you'll get $204,140. However, at 13%, you would earn $720,685. You would end up with 3.5 times as much wealth. 4% is not much in a year, but compounded over 35 years is massive. Therefore, it may make more sense to be willing to take high risk, high expected return investments over a longer time frame than if you only have a short time for the return to work in your favor. Asking you to choose between big oil and stacked tractors or any two stocks is really a bit of a false choice. You do not have to choose one or the other. You can choose both. Now we're going to move from talking about stocks individually to our two stock portfolio. Before we can do the analysis of a two-stock portfolio, we need to talk about correlations. Correlations represent the degree to which any two variables move together. In finance, we often focus on the correlation between returns for a pair of securities. Note that returns are our focus, not the price of the securities. Correlations can range from -1, perfect negative correlation, to 1, perfect positive correlation. It's extremely rare for any two variables to have perfect negative, perfect positive, or no correlation, or a correlation of exactly 0 would be no correlation. Let's look at a few examples. Consider if we take a look at two variables, hours per week studying and average test score for each student in the business finance classes over the past few years. We would likely see a positive correlation, but not a perfect positive correlation. Some students study quite a bit and still struggle with the material for a variety of reasons. Other students may not study much, but find the material intuitive and still do well. However, for most students, studying harder will lead to higher test scores. We may expect a correlation probably in the range of 0.6 to 0.8. Assuming honest answers to hours studied. Now, looking at the two other variables, number of absences during the semester and average test score for each student in the business finance class over the past few years for the physical classes, we would likely see a negative correlation, but not a perfect negative correlation. Some students show up to class but do not pay attention or just find the material difficult. Some students miss classes but spend a lot of time outside of class making it up or find the material intuitive. However, in general, the more often people miss class, the lower their test scores tend to be. We might expect the correlation would probably be somewhere around -0.5 to -0.8. Finally, look at two more variables, height and average test score for each student in the business finance class over the past few years. We might expect that there would be no relationship between these two variables, no correlation. However, it is likely that the chance of the correlation being exactly 0 would be small. Instead, it would likely by chance be slightly negative or slightly positive, probably somewhere in the range of -0.1 to 0.1. For stocks, correlations tend to be small positive values between 0.1 and 0.5 due to general economic conditions or market risk factors, that impact all stocks. However, firm-specific risk factors keep the correlations from getting too high as they impact each stock independently. Typically, firms in the same industry tend to have higher correlations. Refer back to the previous slide that captured some sample correlations based on monthly returns over a time frame. Some examples would include Pepsi Coke that are in the same industry with a correlation of 0.69, but Caterpillar, Molson Coors in very different industries had a correlation of 0.03. In the sample, all but 9 of the 66 of the paired stock correlations were positive and had an average of 0.2. The aggregate bond exchange traded fund, or ETF, is a portfolio of bonds, not an actual company. This allows us to see how stocks are correlated to the overall bond market. The S&P 500 is a measure of the overall stock market of 500 more individual companies in one large portfolio, and also not a company. Both the aggregate bond and S&P 500 are represented by ETFs, which are a type of mutual fund. These allow individuals to own a broad portfolio of stocks as if they were a single stock and can be important investment tools. Now that we understand correlation, we'll now move to expected return and standard deviation for a two-stock portfolio. W stands for weight as a proportion of portfolio in that stock, and K stands for expected return. Big Oil is stock 1 and Stag Tractors will be stock 2. We invest $4,000 into Big Oil and $6,000 Stag Tractors for a total portfolio of $10,000. $4,000 over $10,000 is 0.4 into Big Oil and 0.6 because $6,000 over $10,000 goes into Stag Tractors. The weight should be expressed as decimals and should add to 1. Remember, from the previous examples, expected return for Big Oil was 9% and expected return for Stag Tractors was 13%. You could write these as 9 and 13 in the formula instead of 0.09 and 0.13, but either approach works as long as you're consistent, just don't mix and match. This gives us 11.4%. The weights are still 0.4 for Big Oil and 0.6 for Stag Tractors. The standard deviation for Big Oil is 21.79% and Stag Tractors is 35.87%. Like the returns, you can either express these as 21.79 and 35.87 or 0.2179 and 0.3587. 21.79 and 35.87 are recommended, but it's up to you. Just don't mix and match. Make sure the weights are expressed as decimals and add to 1. The correlation is negative 0.5. Plugging into the formula, we get 18.75%. In this example, standard deviation of two-stock portfolio is actually less than standard deviation of either stock individually. This is due to the extremely low and actually negative correlation, which means that these stocks have a tendency to move in opposite directions. When Big Oil is doing poorly, Stag Tractors does better. When Stag Tractors is doing poorly, Big Oil does better. While this is a bit of an extreme example because negative correlations are rare, we can diversify or reduce our overall risk anytime the correlation is less than 1, which is almost always going to be the case. By reducing our risk, we mean that the risk of the portfolio will be less than the weighted average of the individual stocks. Two cliches come to mind. First, there's no such thing as a free lunch. This is made false by the second. Do not put all your eggs in one basket. Because diversification does not lower expected return, it is simple weighted average that is not affected by the correlation. Our free lunch is that by holding stocks in a portfolio, we can reduce our risk without lowering our expected return. While we demonstrated this with a two-stock portfolio to keep the calculations manageable, the more stocks we add to the portfolio up to a point, the more benefits we get from diversification. Because of the idea of diversification, we can virtually eliminate the impact of firm-specific risk by holding a large portfolio of 50 or more stocks from a variety of different industries and even countries. However, no matter how many stocks we own, we still are faced with market risk. While all stocks are subject to market risk, some stocks are more sensitive to market risk than others. If we have a portfolio of all high market risk stocks, we will have diversified away most of our firm-specific risk, but still have a high risk and high expected return portfolio. Alternatively, if we have a portfolio of all low market risk stocks, we will have diversified away most of our firm-specific risk, but now we'll have a lower risk and lower expected return portfolio. Since we can eliminate most of our firm-specific risk, it becomes less relevant. However, since we cannot eliminate market risk, we need to be able to measure it. It also should be the primary factor that systematically drives returns. We will measure market risk with a concept referred to as beta. Next, we'll estimate the expected return and standard deviation of the S&P 500. The S&P 500 is a portfolio of the 500 more large company stocks, and find it has expected return 10% and standard deviation 14%. Big O has a correlation with the S&P 500 at 0.75, while Stack Tractors has a correlation with the market at 0.32. Calculate the beta for each stock. The formula for beta is below. Looking at this, we see market. Theoretically, the market refers to a evaluated portfolio of all investable assets that one can buy. This would include all stocks across the globe, all bonds across the globe, all real estate, precious metals, precious gems, commodities, collectibles, paintings, antiques, etc., and anything else that someone could purchase as an investment. From a practical perspective, the market is too broad to measure. Therefore, we often see people use a simple approximation such as the S&P 500. The S&P 500 is a market portfolio of 500 larger firms grouped together as one large portfolio, with the largest companies making up a larger portion of the risk and return. The sample correlation standard deviation, we've included the S&P 500 as a measure of the overall market. All the necessary values provide an example. This allows us to calculate the beta of Big Oil and Stack Tractors as follows. Remember that the standard deviation of Big Oil was 21.79% and standard deviation of Stack Tractors was 35.87%. Note that we do not use the expected return on the market here. We'll come back to that later. Also note that while we previously stated that Stack Tractors was riskier than Big Oil when we were evaluating with standard deviation, beta tells us a different story here. The reason that standard deviation can give us a different result than beta is that they are measuring two different types of risk. Standard deviation measured total risk, or firm-specific risk plus market risk. This was important when evaluating investments on their own, as the firm-specific risk had not been diversified away. Beta measures market risk, which is critical when evaluating stocks as well as part of a well-diversified portfolio, because that firm-specific risk is no longer relevant. While Stack Tractors is riskier by itself, its lower correlation to the market, again remember, these are our hypothetical example numbers from the practice problems. This allows us to have less market risk and be less risky as part of a well-diversified portfolio. The average risk level for the market risk is 1. The further the beta falls below 1, the lower the market risk. The higher the beta rises above 1, the greater the market risk. Previously, some sample betas were given. The beta for Boston Beer is a low 0.51, indicating very low market risk. This makes sense as we would not expect Boston Beer's cash flows to be very sensitive to overall economic factors, indicating lower market risk. Alternatively, Amazon has a high beta of 1.47. This makes sense as Amazon, which is an online retailer and tech company, will see its returns be very sensitive to the overall market, indicating higher market risk. While beta is estimated off of past data, what we really need is the beta for the upcoming period. Given that beta changes over time, we need to think of beta as a rough approximation, not an exact value. Because investors know that they can simply diversify away firm-specific risks, the critical risk that they want to focus on and get compensated for should be market risk, which is measured by beta. Since market risk drives investors' required returns, higher beta should have higher required returns as they're riskier. We need a way to formalize the process. Fortunately, this was developed in the 1960s within a theory referred to as the capital asset pricing model, or the CAPM. The CAPM is a broader theory relating risk and return, but the practical application component of the CAPM is the SML, or security market line. While technically they are not the same thing, the SML is a part of the CAPM theory. Many people use the terms interchangeably. We will look at this in the next example. Assuming the current risk-free rate of interest is 4.7%, calculate the required return of each stock. Based on this, should you buy either or both of these stocks as part of a well-diversified portfolio? The formula for the SML is as follows, where K represents the required return for the specific stock portfolio in question. KRF represents the risk-free rate of return. Beta refers to beta and refers to the expected return on the market. Oftentimes, people refer to the portion in parentheses as the market risk premium, as it reflects the additional compensation beyond the risk-free rate that investors need to compensate them for the risk of owning stocks. The idea is that we know stocks are risky investments and investors do not like risk. Therefore, investors need additional compensation beyond a risk-free rate to make it worthwhile to own stocks. However, different stocks have different levels of market risk measured by beta. Higher risk stocks, those with higher betas, should get more than average additional compensation. Alternatively, lower risk stocks, those with lower betas, should get less than average additional compensation. We multiply the market risk premium by beta to adjust for the risk of that specific stock and get the proper amount of additional compensation for that specific stock. We add back in the risk-free rate to get the total required return for that specific stock. If we apply it to our specific stocks, we'll get the following. Remember previously, beta for big oil was 1.17, the beta for stacked tractors was 0.82, and the expected return for the S&P 500 was 10%. The required return for big oil is 10.9%, and the required return for stacked tractors is 9.05%. From the previous examples, the expected return for big oil was 9%, and the expected return for stacked tractors was 13%. For big oil, the expected return of 9% is less than the required return of 10.9%, meaning that we will not on average earn enough to compensate us for the risk. Therefore, we should not buy big oil, assuming we do not already own it, or we should sell big oil, assuming we do already own it. Alternatively, the expected return for Deere of 13% is more than the required return of 9.05%, meaning that we will, on average, earn more than enough to compensate us for the risk. Therefore, we should buy Deere stock. We should also use these required returns in the stock valuation models introduced previously. Remember that back then, the required return was given. There are a couple of challenges in using the SML. First, there is no truly risk-free rate. All investments have some level of risk. However, typically the yield on U.S. Treasury securities, debt issued by the U.S. federal government, is used as the risk-free rate. There is some debate about whether short-term debt, the 3-month Treasury bills, should be used as shorter-term securities are less sensitive to changes in the market rate of interest and thus less risky, or long-term, like 10-year Treasury bonds, should be used as stocks are a long-term investment, and using 3-month securities introduces reinvestment risk as we do not know what rate will be in place after the first 3 months have gone by. The 10-year Treasury is typically used. In addition, there is some debate about the appropriateness of using Treasury debt in today's economic environment, as the U.S. no longer has a AAA rating from the S&P, and the increasing levels of U.S. federal debt may introduce some default risk. At least for now, investors are accepting incredibly low yields on U.S. Treasury debt, which indicates that while it may not be 100% risk-free, it is still viewed as a very low-risk investment. A second problem was referred to earlier, which is that ideally we need the beta for the future time horizon, and we can only estimate the past. As this estimation risk means we do not know the true beta, our SML results will be subject to estimation error as well. A third problem is that the market risk premium is unknown, and there is no way to determine exactly what the expected return on the market is. We know that the market risk premium needs to be positive, or risk-averse investors would not take on the risk of holding stocks that they expected to earn less than the risk-free rate. But we do not know whether it should be 3, 5, 7%, or some other value. Historically, it's been estimated to range from about 3% to 7%, depending on economic conditions and recent performance of the stock market. When the economy is strong and the recent performance is strong, investors are more willing to hold stocks and the market risk premium shrinks. When the economy is weak and the recent performance of stocks has been strong, investors are hesitant to hold stocks and need more compensation to get them to do so, making the market risk premium larger. Note that this does not say firm-specific factors where company X gets hit with a lawsuit or company Y develops a great new product don't influence stock returns, just that they are not systematic. Instead, they will cancel out in larger portfolios and become irrelevant. It also doesn't say every high beta stock will outperform every low beta stock. Again, firm-specific issues can impact individual stocks, or that high beta stocks as a group will always outperform low beta stocks. Actually, high beta stocks should do worse in periods where the market as a whole does poorly. Unfortunately, studies indicate that neither of these implications hold consistently. Other factors listed below have been shown to impact returns on a systematic basis. Second, it is not clear that high beta stocks do on average earn higher returns over time. Other factors that have been shown to influence stock prices include firm size. Small firms tend to earn higher returns than large firms even after controlling for beta. The market value to book value ratio. Value firms, firms with low ratios, tend to earn higher returns than glamour or growth firms, firms with high ratios, even after controlling for beta. Momentum stocks that have outperformed the market over the last 6 months are likely to earn higher returns over the next 6 months than stocks that have underperformed the market over the last 6 months, even after controlling for beta. These issues have led to the development of alternative asset pricing models, which go beyond the scope of what will be discussed here.